80 minutes. $1 trillion erased from the silver market like it never existed. Not a slow bleed, not a normal correction, a financial shockwave. If you blinked, you missed it, and if you don't understand it, you're exposed to it. Because this wasn't just volatility, this was structural stress revealing itself in real time. When silver started falling, it didn't drift lower. It accelerated. Every dollar down triggered another wave of forced selling. Every wave triggered another margin call. That's how leverage works. It doesn't decline gently, it collapses aggressively. Funds weren't calmly exiting positions. They were being removed by the system itself. And here's the part that should make you uncomfortable. Most of that selling happened in a very tight time window. Liquidity thinned out, volatility expanded. When liquidity disappears in leveraged markets, price doesn't move logically, it moves violently. Now think about what that means. If $1 trillion can vanish in 80 minutes during normal trading hours, what happens during true crisis conditions? Because this wasn't a war announcement. This wasn't a global banking freeze. This was positioning unwinding. And positioning unwinds don't ask for permission. They simply cascade. But here's where it gets interesting. While paper markets were collapsing, physical sentiment didn't collapse at the same speed. That's not how true demand destruction looks. In real supply gluts, everything weakens together. Instead, what we saw looked more like a pressure release valve, a sudden forced purge inside leveraged contracts. When price drops because people don't want something, inventory builds, premiums fall. But when price drops because traders are forced out, that's different. That's mechanical. And mechanical selling creates distortions. Distortions create opportunity and risk. Now, zoom out with me for a second. Silver isn't a meme stock. It's an industrial metal. It's a monetary metal. It sits inside solar panels, electronics, infrastructure, and investment vaults. Industrial demand doesn't disappear in 80 minutes. Mine supply doesn't double in 80 minutes. So what changed in 80 minutes? Leverage changed. Risk tolerance changed. Margin requirements started biting. Algorithms started accelerating. And when algorithms dominate thin liquidity, humans don't control the price anymore. Speed controls the price. That's why the drop felt shocking. Because it wasn't emotional selling, it was structural selling. But structural selling has a weakness. It exhausts itself. Once the forced liquidations are done, natural buyers start evaluating value. And that's the moment most retail investors miss. They're still reacting emotionally while the structure has already shifted. Now ask yourself honestly, during that 80-minute bloodbath, what did you feel? Fear, confusion, urgency? That reaction is natural, but markets are designed to exploit natural reactions. If you were holding leveraged paper exposure, your position was vulnerable to forces outside your control. If you were holding physical metal without leverage, your experience was completely different. That distinction matters more than price itself, because structure defines survivability. Here's something most people won't admit. Violent drops often happen near important turning points, not always, but often enough to matter. Because when weak hands are flushed out rapidly, supply transfers. And transfers create new bases, but only if underlying demand hasn't disappeared. So the real question isn't why did silver crash? The real question is, did the reason for owning silver disappear? Did industrial usage collapse overnight? Did global monetary uncertainty vanish? Or did leveraged positions unwind during thin liquidity? Those are completely different narratives. If this was demand destruction, price weakness can persist. If this was leverage unwinding, stabilization can happen faster than people expect. And that's where discipline separates investors, because panic reacts to movement, strategy reacts to structure. Right now, most people are staring at the red candle. Very few are analyzing the mechanics behind it. But mechanics determine what happens next. And what happens next will not reward emotional decision-making. It will reward preparation. Because if $1 trillion can disappear in 80 minutes once, it can happen again, up or down. The only question is whether you'll be reacting or positioned. Pause here. Before you move to part 2, ask yourself one honest question. Are you exposed to leverage, or are you insulated from it? Part 2 goes deeper into who was actually selling, why the timing clustered the way it did, and what the next volatility phase could look like. And trust me, the second layer is more important than the first.